After the Fed's big announcement last week, it's not surprising that the intermediate term outlook and the weekly and monthly charts still look healthy. They still look bullish. QE does matter. We've done extensive research on how QE works. In the real world, you can find a series of QE videos that are extremely informative and may change your mind about whether or not QE matters. QE in the short to intermediate term is bullish for stocks, precious metals, copper, commodities, etc. It tends to be bearish for bonds and the dollar. If you look at the reaction in the markets, they're following this script thus far to a T. These were strong last week. These were weak. Europe, a lot of people don't understand that the worst case scenario or the worst fears of market participants have been taken off the table. Why is that? The worst case scenario is a full bailout for either Spain or Italy where they lose access to the bond markets. When Spain and or Italy now ask for a quote-unquote bailout, they will not lose access to the bond markets, especially in the short to intermediate term, since the ECB has told them that they will come in and buy bonds in the open market. We believe that this is the reason why markets are breaking out to the upside, more so than anything that the Fed is doing. The situation in Europe unequivocally has improved, at least for the short to intermediate term. Doesn't mean it's fixed long term, but stocks could go up, and they could go up for a lot longer than most people think. There's no question the markets are extended a little bit. We'll get a 3 to 5 day pullback, even in the context of higher highs and bullish outcomes. The give back that we see in precious metals, especially silver, could be pretty significant in the short term, but most likely with the Fed printing money and the ECB committing to print, silver and gold and copper will probably go higher. Weekly, monthly charts still look bullish. In this video, we will review these markets, including risk on, risk off ratios, and we'll show you situations where we say last time this happened, stocks went up. It's important to understand that our market models, our proprietary market models, charts, technical analysis, really doesn't predict anything. These charts that we're looking at are very, very similar to the temperature gauge in your car. Temperature gauge in your car does not predict that your car will overheat in 2 days or 2 weeks or 2 hours. You have to keep an eye on the temperature gauge, and if it starts to rise, then you may get a little bit nervous about your car overheating. Charts work the same way. Now we're in the normal operating range for bullish outcomes. If the temperature gauge starts to overheat or the chart starts to deteriorate, we need to respect that. So we have to pay attention, and pay attention with an open mind. Now let's look at some charts. I'm on the road this week, so we'll scroll through some charts quickly here. We're looking at the Nasdaq Composite. Weekly, this is the 22-week moving average, the blue. When the slope turns up, good things happen. Slope turns up, good things happen. Positive slope, good things happen in tech stocks. You can see here in the present day that this flat slope is clearly trying to turn up in a bullish manner. Now we're looking at the Dow Jones Industrial Average. This is a weekly chart. Similar situation, the 22-week moving average turning up in the present day. Here, bullish. Here it turns up. Gains, stock market follow. MACD on the Dow Jones Industrial Average. That's black over red on a weekly chart. That's bullish for the Dow. And notice here that the histogram ticked up higher this week on the Fed QE infinity announcement. All things being equal, this chart is bullish. You can also see a breakout here of 2 trend lines on a weekly chart. We had a weekly close above these trend lines here. As long as this holds, this chart is bullish. Now we're looking at the S&P 500 weekly. This is the 22-week moving average. Similar situation. When it turns up, good things happen. The slope of the blue line turns up, good things happen. Clearly here, the slope similar to the Nasdaq and the Dow Jones Industrial Average turning up. You can also see a clear breakout here on a long-term trend line dating all the way back to early 2011. This is a chart that we've looked at several times. This is the S&P 500 index. This is a monthly chart. We're looking at the rate of change here. When the rate of change crosses over the center line here, good things in the stock market, this is the S&P 500, tend to happen. When the rate of change crosses below the center line in a bearish manner, as it did here, bad things tend to happen in the stock market. Bullish cross here, gains in the stock market followed. Here we held up for the most part above. We're well above the zero line and moving higher in a bullish manner. This rate of change line here looks similar to this point here where gains followed, and similar to this point here where gains eventually followed in the stock market. Moving forward here, this is the US dollar that we're looking at. Obviously, with the Fed printing money, you would think that the dollar would be weak. This is the monthly dollar here where I've got the cursor. You can see here we've got a bearish breakout on a monthly chart. That's a bearish break here. The rate of change for the US dollar when it crosses below the center line as it did here, if I move up, this is the S&P 500, gains in the stock market followed. Crosses below the center line, rate of change in the US dollar monthly, gains in the stock market followed. Here you can see we're about to cross potentially below the center line. This point here looks similar to this point here and this point here where gains in the stock market followed. Moving ahead here, now we're looking at mid caps. This is a weekly chart. Several things here. Weekly long-term trend line. Clearly, we've got a bullish breakout here. This is the 15-week exponential moving average here in blue. This is the 32-week exponential moving average here. All things being equal, you'd like to see blue above red, and you'd like to see the slope of these moving averages be pointing up in a positive manner. And we'd like to see the Russell 2000 or the IWM ETF price above this. Right now we have all of that. This chart looks bullish. We also have MACD, bullish state, black above red, and you've got the histogram ticking up. We also have the MACD black line above the zero line, which tells you on this weekly chart that we're in an uptrend. This is a monthly chart of basic materials. We're looking at the 14-month exponential moving average in blue. When this moving average rolls over, bad things tend to happen in basic material stocks. When it turns up in a bullish manner, gains in material stocks tend to follow. Turns down here, you've got a weak market. In the present day, we have the 14-month exponential moving average right here trying to turn up in a bullish manner. We have price in the present day, black line above the moving average. That's similar to this point here where gains followed, similar to this point here where gains followed. We also have a long-term breakout. This trend line here goes all the way back to the spring of 2011. You can make an argument that this is a symmetrical triangle that I'm tracing out here. If that's the case, your target could be much, much higher for material stocks, which would not be surprising considering the Fed has just announced that they're willing to print unlimited amounts of money. This is a stock chart that we've looked at in the past, or the concept we have. This is the stock market, or the SPY ETF, divided by the AGG, aggregate bond ETF. So we can think of this as the ratio of risk on to risk off, or the ratio of stocks to bonds. When the black line or the ratio is rising, stocks are in favor relative to bonds. When the black line is falling, bonds are more in favor relative to stocks. Pretty much everything on this risk on, risk off chart is bullish. On this chart, we also have what appeared to be somewhat of a symmetrical triangle shape here that I'm tracing out. We have a clear bullish breakout on this weekly chart. We also have these moving averages here, both turning up. We have the shorter term 4-week exponential moving average above the longer-term 7-week exponential moving average. Prices above both. This is a bullish posture here. If we slide down, we also have MACD on this chart. Black is above red in a bullish posture. You can see here the MACD histogram last week ticked up in a very bullish manner, telling you that the move is backed by momentum. And possibly the most important thing on this chart is that RSI, or the Relative Strength Index, also broke out, confirming the move higher here. Everything on this chart, as long as it stays in this manner, points to higher highs in stock prices and lower lows in bond prices. Similar situation here. We're looking at the ratio of stocks, or SPY, to IEF, which is the intermediate term 7 to 10 year Treasury bond, ETF. So again, we're looking at the ratio of risk on to risk off. When it's rising, it's bullish. When it's falling, it's bearish for stocks. We were concerned here. We noted that when we hit resistance here with the ratio, this is the S&P 500 here, that stocks perform poorly. Resistance, stocks did poorly. We also hypothesized that this was potentially a symmetrical triangle, and it tends to be a continuation pattern weeks ago. And we hypothesized that we might get a bullish break in this risk on to risk off chart. We did get that. This bullish break tends to be bullish for stocks and bearish for bonds in a similar manner. We have a bullish breakout here. When you have bullish breakouts on weekly RSI, they tend to be good signals. If we move down a little bit further, Williams percent R confirmed it. This isn't a weak move. This is telling you momentum is strong. If you come down here for tricks, black over red, that's bullish. CCI confirmed it. Everything looks good there. Ultimate oscillator above 70 confirmed it as well. As long as we hold this breakout, it's bullish for stocks and bearish for bonds. Similar situation here, similar chart, maybe just looking at some different trend lines. You can see here we clearly broke above this downward sloping trend line. We held above this upward sloping trend line. Now we potentially have white space here that might be filled. If this white space was filled, it would be bullish for stocks and bearish for bonds. Moving forward here, we're looking at another risk on to risk off chart. This is the consumer discretionary ETF, or XLY, relative to the consumer staples ETF, or XLP. We're looking at a monthly chart here. We've actually removed the ratio, and now we're just looking at two moving averages for this ratio. So this is the 3-month exponential moving average in blue for this ratio. The red line is the 9-month exponential moving average. You can see in the present day that the shorter term moving average, the blue, is trying to cross above the red. That's a bullish cross for risk relative to risk off. The last 2 times that we had a similar bullish cross was here near the bottom, when the stock market bottomed in the spring of 2009. This is the S&P 500 monthly. After the bullish cross, gains in the stock market followed. Here, we held above the line, and the blue started to move away from the red in a bullish manner. Gains in the stock market followed. Early in 2012, after the ECB printed enormous sums of money and gave unlimited 3-year loans to European banks, bullish cross, blue above red, blue above red. Early in the year, gains in the stock market followed. As long as this chart holds, it's bullish for stocks and bearish for risk-off assets like bonds. If we move down here, RSI is clearly above 50, which tends to be bullish for risk-on this weekly chart. This is RSI for this ratio. You can also see this is the stock market here. When you get a weak move higher in Williams percent R, this is telling you that the move higher was weak from a momentum perspective. Stocks did not perform well. This is the S&P 500. Here you can see this is confirming the move higher. in risk on relative to risk off. We're well above negative 20. Doesn't look anything like this move in 2011 when we had weakness in stocks. Similar situation here. Now we're looking at a weekly version of this same chart. This is consumer discretionary, risk on divided by consumer staples, risk off on a weekly basis. Here is where you see when you get Williams percent R giving you a weak momentum move, the stock market fell again. That's not what we have here at all. This looks bullish here, telling you that this move and this bullish cross, again, when the blue moving average or the 15-week exponential moving average crosses above the 26-week or longer-term exponential moving average for this ratio of XLY to XLP, that's bullish. Here you can see blue held above red. This is the stock market down here. Gains in the stock market followed. Bullish cross. Blue above red. The slopes of both lines are moving up. Gains in the stock market followed. Here we've got the slope of both moving averages turning up in a bullish manner. And blue, if you look closely here, is slightly above red. This point here looks similar to this point here. And this point here, where gains in the stock market followed. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.